The government and the Reserve Bank have jointly issued a bunch of amendments to regulations governing investments by Indians overseas. Now, these include both direct investment by Indians abroad and portfolio investment by Indians abroad. The rules actually allow easier investment by Indian-owned foreign companies back in Indian businesses. What in the past could have been condemned as round-tripping, now a bit of it is being made easier. The reason, according to the ministry, is that Indians are getting into global supply chains and therefore two-way investments need to be eased. So how easier is it going to be to invest abroad on the part of Indian entities? I have with me two stalwarts on the subject, Nandish Vyas, the senior partner at AZB and Partners, and G. Padmanabhan, the former executive director at RBI, who in his time perhaps framed all these rules. Mr. Vyas and Mr. Padmanabhan, thank you very much indeed for joining us. Mr. Padmanabhan, first let me come to you. What do you think is the most important takeaway in terms of ease of business from these rules?
Lata, good morning. Happy to be back with you. I think let me start by saying that the way in which these things happen with the government, the Reserve Bank, is that once a set of guidelines have been in operations, I think there are several set of practical issues that come up. There are certain conceptual issues that get flagged. And once these issues keep cropping up, then the regulator starts looking at whether it's a need for changing or giving a complete overhaul as far as these regulations are concerned. So you mentioned one important one among them. So let me start with some of the issues which I think are quite critical, which have been practical issues in the past, and where I think the Reserve Bank and the government have addressed this in the present set of, I think there are three sets. There is a rule, there is a regulation, and there are directions.
Yes.
Now, the first one, the most important one, according to me, is a clear distinction between what constitutes an ODI and what constitutes a portfolio investment. This is critical because earlier, even if you have 0.2% investment in some entity, you have to go through the entire rigmarole of reporting and call that as an overseas investment, etc. That's the first major one.
So one minute. So the easy part for us to understand is, if it is more than ODI, if it is more than 10% investment abroad in an entity, then it is ODI. If it is less than 10, it is OPI. Broadly, is that the understanding?
That is correct. That is falling in line with the international norms.
Yes.
I think that has been already implemented in the FDI regime. Now they have clearly called that out as far as the ODI regime is also concerned. So that's very critical. The second, I think, where they were creating huge amount of problems and which you called out is wherever there was an FDI ODI link, I think the issue of what they call the round tripping cropped up. I think the Reserve Bank and the government, even when I was there, I think have been in conversation with each other to see how to liberalize. I think they have done a fairly good job of saying that as long as you come back to India into entities which have up to 2 layers, it would not be called round tripping. So that's a major change, I think, as far as I'm concerned. The third important thing, which according to me is very crucial, is that the Reserve Bank or the regulations have taken a stance that unless you are in the financial sector in this country, you cannot go overseas and invest into financial sector. Now, this is an issue on which I think we had a debate internally for a long time. And the issue that we need to take care of is that as long as the overseas regulations, the regulators, government do not have objection or problems with any of the entities coming in, why should the Indian regulator worry about an entity which is not a part of the regulated financial system going and investing overseas? I think that has been set right by saying that even an entity in the non-financial sector, which could not have invested in the financial sector overseas, and this meant that a lot of opportunities, particularly investing into fintechs and others, went begging because they could not do this investment. Again, I think I can go on, probably 3-4 other important issues are there. I would leave it to you whether you want me to complete that, and as we go on, you can probably bring
why don't I
then we can discuss.
Yes, Mr. Padmanabhan, why don't I get to Nandish and ask him what are his key takeaways? Okay, Nandish, the important points that Mr. Padmanabhan has made, FDI, ODI, direct and portfolio is a little clearer now. the fact that everything is not round tripping. If you invest abroad in a company and that company invests back in you, it will enable easier, probably when India gets into a supply chain, global supply chain, these things will be needed.
Yes.
And of course, an Indian entity, say a Tata Group company, a Birla Group company, a Reliance Group company, can invest in a finance company abroad, and that need not be wrong. Those are the major simplifications he has pointed out. What more should are the result of the new rules?
Sure, Lata. So thanks for having me here. I'll sort of put this in 5 buckets,
Okay.
the types of changes that have been made. The first bucket is what I would call as those which have a positive impact on deal structuring, where you already covered the point on round tripping.
Yeah.
The ODI, FDI bit, that is now permitted subject to 2 layers. In fact, for certain types of entities such as banks, NBFCs, insurance companies, and even government companies, that particular exempt, I mean, it's a full-fledged exemption.
Okay.
The second thing that has been expressly allowed is deferred consideration subject to certain safeguards, which also gives flexibility for the Indian entities to sort of pay over a period of time subject to meeting certain criteria in terms of valuation, etc.
Okay.
And the third area where there's clarity from a deal making perspective is that swap has been explicitly allowed under the automatic route.
Okay.
Coming to the second bucket of changes, which is the types of investments. We spoke about ODI and OPI,
Yes.
which sort of now gives clarity for the portfolio investments up to 10% in listed companies offshore. I think a couple of other changes on the types of investments which are important is the fact that for debt investments, you now have a very clear-cut definition of control, which is debt investments can be made in entities where the Indian entity has
control.
10% or more in terms of shareholding or voting power. The overall size of a 1 billion cap, which was sort of there in terms of an overall cap for any Indian entity, that has been removed. So that's on the types of investments. On pricing and valuation, there's clarity because of the fact that there's going to be arm's length pricing. And as I already mentioned, deferred consideration is allowed. The fourth bucket is on the sectors. We spoke about financial services sector, a couple of other areas where there are good liberalizations is education and hospitals, because now Indian trusts which run education, basically which run schools and colleges or which run hospitals are allowed to invest overseas.
Yes.
The government has also indicated that in terms of strategic sectors such as energy, natural gases, and for that matter, even for startups, they are going to be more flexible in terms of allowing investment above the typical 400% limit. So that's on the sectors where there's a significant broadening. And the last part is on other matters such as sale and write-off, where as a practical matter, earlier an RBI approval was needed when any entity which was under investigation needed to make an overseas investment or a divestment for that matter. Now all you need is an NOC from that concerned investigation agency. And in fact, even if the agency doesn't respond within a certain timeline, it's a deemed NOC. This issue used to affect several companies. That has been changed in terms of the regime. Write-offs or reducing and diminution in value of up to certain limits is now allowed, and there are certain conditions such as a valuation report confirming that the diminution is based on a fair value. But other than that, it's been permitted. So I think lots of positive changes.
Yeah, lots of positives. And, basically that suspicion which surrounded everybody and everything, that has been reduced. Again, there has been such a spate of NPAs and willful defaulters in the past 5 years after the asset quality review that, large groups may be hamstrung from investing abroad. Even that to some extent has been eased. Mr. Padmanabhan, anything else we should know in terms of ease of doing business?
No, Lata, I think a couple of things, let me sort of clarify. I think the 1 billion limit which Nandish mentioned has not gone away. It is there in the directions very clearly. Anything above 1 billion requires RBI approval. So 1 billion limit, that is more for a market flow issue, not to do with FEMA, but basically that 1 billion is still retained. That is one thing. Now, the deferred consideration, I think it is important to understand how this regulation is moved. There was nothing in the regulation. Earlier regulation the ODI did not talk about the deferred consideration. And the interpretation that we were all taking was that because it's an outflow and the outflow is being deferred, we should not have a problem.
Okay.
But at some stage later, Reserve Bank of India came to sort of interpret saying that we should have parity on both sides. If for FDI we have a deferred consideration for one rule, the same kind of rule, irrespective whether it is written into law, has to be applied. And I think they have been applying this in the interim period. Now what has happened is they have clearly now thought through this, called out and said that as long as a deferred consideration which is written into the contract, there should be no problem.
Okay.
I mean, the Reserve Bank should not worry about it.
Okay.
I think importantly, not only divestment, I think they have even put the restructuring under the automatic route and clearly calling out that as long as it's on a fair price valuation or whatever is the valuation done overseas, there should be no
There is no need for argument.
I have a slightly different take as far as the no objection from the external agencies are concerned. Even earlier it was there, but the way it was happening was that Reserve Bank of India was writing to these agencies and asking for a no objection. And I think there was a time of 30 days or 45 days given. And if no response was received, Reserve Bank of India said that we will go ahead.
Okay.
I think there were a couple of things which prompted Reserve Bank of India to change this and say that now the applying entity itself should get this no objection. I think one thing is probably which Nandish knows better. There was a court case. The Reserve Bank was taken to the court saying that based on somebody else's, recommendation, Reserve Bank of India should not be allowing or not allowing. Reserve Bank of India should apply its own mind and take a view in the matter because there is nothing written down in the regulations.
Fair enough.
Now they have clearly called out that this is a prerequisite for Reserve Bank of India to take a view in the matter. So in my view, again, they have cleaned that up a bit rather than bringing anything new into the system. But more importantly, one thing which I think we have sort of missed is, I think there are a lot of concessions beyond this which has been made as far as investment into IFSC is concerned. So I think now there is a good chance of IFSC being able to become a good international.
That's a big one. Actually, I'm out of time, but I want to let Nandish have the last word on this IFSC. Does it make IFSC a more vibrant place and where Indians can invest?
No, absolutely it does. And in fact, what has also been clarified, as Mr. Padmanabhan alluded to, is that in fact, even a financial institution in an IFSC will not be subject to any of the sort of restrictions, so to say, in ODI. As Mr. Padmanabhan said, there's clarity now in investment into an IFSC. So that's again a big welcome move. I'm sorry we're out of time, but that's a wealth of points I'll have put on the table. I guess later today on Big Deal, these will be analysed more clearly by my colleague Nisha Podar. Thank you very much, Mr. Padmanabhan and Nandish Vyas, for joining me and explaining. It's going to be easier for Indians to both do FDI and ODI, both sides, so that we become part of global supply chains. And of course, there are a host